Imagine waking up one day to find the price of your morning coffee has doubled. Welcome to the world of inflation. Inflation. It's a term you've probably heard tossed around in the news or in financial discussions. But what exactly does it mean? In the simplest terms, inflation is the rate at which the general level of prices for goods and services is rising, and subsequently, purchasing power is falling. Essentially, it's the cost of living going up. And while a little inflation is typically seen as a sign of a healthy economy, when it gets too high, it can start to erode your purchasing power. So, what causes inflation? There are two primary types: demand pull and cost push inflation. Demand pull inflation occurs when demand for goods and services exceeds their supply. On the other hand, cost push inflation happens when the costs of production increase, causing producers to raise prices to maintain their profit margins. Now let's talk about the ripple effects of inflation on the economy. When prices rise, your dollar buys less. This is the erosion of purchasing power. Imagine this: if the inflation rate is 2% per year, the loaf of bread that costs $1 today will cost about $1.02 next year. It might seem insignificant when you look at it in the short term, but over time, the cumulative effects can be substantial. Key indicators of inflation include the Consumer Price Index, which measures the average change over time in the prices paid by urban consumers for a market basket of consumer goods and services, and the Producer Price Index, which measures the average change over time in selling prices received by domestic producers for their output. Inflation is not just about pricier coffee, it's about the diminished value of your money over time. So as we peel back the layers of this economic phenomenon, it's crucial to understand how it can impact your financial health and investment strategies. Now let's see how your investment portfolio might react when inflation hits. Inflation is like a wave, and just as a wave can erode the shoreline, inflation can erode the value of your investments. When prices rise, the purchasing power of money falls, which can impact different types of investments in varying ways. Let's start with stocks. When inflation is on the rise, companies may face increased costs for raw materials, labor, and other operational expenses. While some companies can pass these costs on to consumers, others may see their profit margins squeezed, which can lead to lower earnings and potentially lower stock prices. However, this isn't a blanket rule. Some sectors like technology or healthcare may fare better during inflationary times due to their potential for higher growth and profitability. Moving on to bonds, they can be particularly sensitive to inflation. As inflation increases, the fixed interest payments from bonds become less valuable in real terms. This could lead to a decrease in bond prices and lower demand for bonds in the market. Next, real estate. Inflation can actually be a friend to real estate investors. As the cost of construction materials and labor rise, so too does the value of existing properties. However, higher inflation can also lead to higher interest rates, which can increase the costs of mortgages and dampen demand for property. Lastly, commodities. These are often seen as a hedge against inflation. As the prices of goods rise, so too can the price of commodities like oil, gold, and agricultural products. But remember, commodity prices can be volatile and are influenced by a host of other factors beyond inflation. To sum it all up, inflation can create waves in the investment landscape. But remember, while it may erode the purchasing power of money, it doesn't mean it erodes opportunity. It's all about understanding the dynamics and adjusting your sales accordingly. As inflation rises, the real returns on your investments could take a hit. But don't worry, there are ways to preserve your wealth even in the face of inflation. One of those ways is through conservative investment strategies. These strategies involve investing in assets that are less likely to be affected by inflation, or that can even benefit from it. For instance, gold has long been considered a safe haven asset, as its value tends to increase when the cost of living rises. Another strategy is to invest in inflation-protected securities, also known as TIPS. These are government-issued bonds that adjust with inflation, so your investment grows at the same rate as inflation, preserving your purchasing power. Lastly, consider dividend-paying stocks. Companies that have a history of paying dividends are often more established and can weather economic storms better than those that don't. Their dividends can provide a steady stream of income, which can be particularly valuable when prices are climbing. These strategies can help you maintain your wealth even as prices climb. For those who like to stay one step ahead, let's talk about proactive strategies to hedge against inflation. As we navigate the financial labyrinth, it's crucial to understand that not all investments are created equal. Some are designed to thrive in an inflationary environment, and today, we'll delve into those. First up, Real estate investments. Owning property can act as a powerful hedge against inflation. As the cost of living rises, so too does the value of property and the rent you can charge for it. This makes it a tangible asset that can provide a steady income stream, something particularly valuable when prices are on the upswing. Next, we have infrastructure assets. Think toll roads, bridges, power plants, and the like. These investments tend to generate reliable cash flows, which can increase with inflation, making them a solid option for investors hedging against rising prices. Then, there are commodities. As the raw materials used to produce goods, their prices often rise with inflation. Precious metals like gold are a well-known hedge, but don't overlook agricultural products or energy commodities. These can also provide a buffer against inflation. Finally, let's discuss options. Options contracts can offer a sophisticated way to hedge against inflation. By buying options, investors can bet on the direction of interest rates or commodities prices, which are often closely tied to inflation. Remember though that all these investment strategies come with their own risks and rewards. It's essential to do your due diligence, understand your risk tolerance, and consult with a financial advisor if needed. These strategies are not one-size-fits-all solutions, but tools to consider in your inflation-fighting toolbox. With the right strategies, you can not only withstand inflation, but potentially profit from it. To further bulletproof your portfolio, consider the principles of diversification and asset allocation. Diversification, a time-tested strategy, involves spreading your investments across various assets classes such as stocks, bonds, and commodities. This mitigates risk by ensuring that potential losses in one sector don't spell disaster for your entire portfolio. Now let's talk about asset allocation, the sibling of diversification. This strategy involves dividing your investments among different asset classes based on your financial goals, risk tolerance, and investment horizon. In inflationary times, it might be prudent to allocate more towards assets that historically perform well during inflation, such as commodities or real estate. However, remember that the key is balance. Too much concentration in one area can expose you to volatility and risk. So, spread your investments across a range of asset classes, including those that offer stability, such as bonds and dividend-paying stocks. In the end, the aim is to create a portfolio that can withstand inflationary pressures and market volatility, yet still offer potential for growth. A balanced portfolio can serve as your financial lifeboat in inflationary waters. To navigate the inflation landscape, you need to adapt. Here are some tips. A key strategy in adaptive investing is regularly rebalancing your portfolio. Just as a gardener prunes and adjusts plants to promote growth, you should do the same with your investments. By doing so, you ensure that your portfolio maintains its original asset mix, and you lock in gains from high-performing investments while expanding potential growth areas. Next, consider the balance between short-term and long-term investments. Inflation can erode the value of money over time, so a mix of short-term investments that offer quicker returns and long-term ones that promise growth and stability can help counteract this. Finally, stay informed about economic trends. Knowledge is power, and understanding the economic landscape can guide your investment decisions. Keep an eye on key indicators like inflation rates, market trends, and geopolitical events. This will enable you to make informed decisions and adapt your strategy as needed. Adaptive investing is about staying in the game no matter what the economic climate. Don't just take our word for it, let's hear from some experts. Renowned financial analyst Edward Chancellor argues that in times of market volatility and inflation, passive investment strategies may not cut it. Instead, a more nimble approach is needed to navigate the turbulent waters. Take the case of the Bank of England. As UK gilt yields skyrocketed, threatening the stability of UK pension funds, the bank launched an emergency bond purchasing program. This swift move not only saved the day, but also demonstrated a proactive response to a potential financial disaster. These real-world examples show that during inflation, innovative and flexible investment strategies can make all the difference. It's not about avoiding risk, but rather understanding and managing it. As these success stories show, it is possible to thrive even in an inflationary environment.